Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning from me, Peter Lewis, and welcome to Friday. It's been a busy week for business, economic and finance news, and I have more updates for you in just a moment. This is Money Talk for Friday, the 14th of June. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 50 million customers across 10 countries. In today's business and finance headlines, the Hong Kong Monetary Authority on Thursday left its base rate unchanged at 5.75% for the seventh time after the US Federal Reserve left monetary policy on hold. In a statement, the HKMA said that with recent economic data showing mixed signs and inflation remaining high, it's uncertain when the Fed will start cutting interest rates. Leading local banks, including HSBC, Bank of China and Standard Chartered, announced they were keeping their rates unchanged. The Bank of Japan started its two-day meeting yesterday and will deliver its monetary policy decision later today. The BOJ is expected to stand pat on interest rates and keep its short-term rate unchanged at 0% to 0.1%. Premier Li Chang arrived in New Zealand Thursday on the first leg of a week-long regional tour that will also take in Australia and Malaysia. It's the first trip to New Zealand in 7 years by a Chinese premier. Following the meeting between the two leaders, Premier Li said on Thursday his nation's differences with New Zealand mustn't become a chasm, and he pledged greater trade and friendship. Hong Kong's listed shares of BYD, the world's largest electric vehicle manufacturer, rose almost 6% in Hong Kong after the European Commission announced lower than expected tariffs for the company. The European Commission on Wednesday told car makers it will provisionally apply additional duties of 17% to 38% on EVs imported from China starting next month, on top of an existing 10% tariff. BYD's additional tax of 17.4% is the lowest among all car makers listed in the announcement, and shares of other mainland EV makers also jumped as analysts expressed the view that the move by the EU is modest compared with the 100% tariffs imposed on Chinese EV imports into the US. On today's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and Simon Kavanagh, partner at BDA Partners. And with a view from Australia is Toby Lawson, CEO at Statton Partners. And today's Asian business newsletter, which goes with this show, is now available at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Thursday, the S&P 500 and Nasdaq closed at new record highs for the fourth consecutive session following the Federal Reserve's interest rate decision the previous day, and also after data released on Thursday morning showed a cooling labour market and easing producer prices. The S&P 500 closed 0.2% to end at 5,434, despite 60% of stocks in the benchmark index declining on the day. The Nasdaq Composite advanced a third of a percent and closed at 17,668. The Dow underperformed the other two main indices, slipping 65 points or 0.2% to end at 38,647. US Treasuries rallied for the third day in a row. The yield on the two-year note fell 5 basis points to 4.70%, while the yield on the 10-year note was down 5 basis points to 4.25%. That's the lowest level since March the 28th. The dollar regained some ground after falling Wednesday. The US dollar index was up 0.5% at 105.22. Russia halted trading in US dollars, the euro and Hong Kong dollars on the country's flagship stock exchange Thursday after the US imposed fresh sanctions aimed at further tightening the screws on Russia's ability to fund its war in Ukraine. The dollar was up 0.33% against the yen at 157. In Shanghai, the yuan dropped 0.2% to 7.25 renminbi per dollar. And gold has extended its decline since the FOMC's interest rate decision. It ended the day 0.8% lower at $2,304 an ounce. Brent crude oil settled 0.2% firmer at $82.75 a barrel. Cryptocurrencies were sold, with Bitcoin tumbling 3% to around $66,700. And Hong Kong's Hang Seng Index rose 175 points, or 1% yesterday, to 18,113, rebounding from the 6-week lows hit on Wednesday. It was powered by gains in electric vehicle stocks, despite the EU slapping tariffs of up to 38% on Chinese EV makers, and the tech index jumped 1.3% higher. On the mainland, the Shanghai Composite fell 0.33% to an almost 2-month low of 3,029. And this morning, futures markets pointing to a decline of about 200 points for the Hang Seng Index at the open, projected to start the day at around about 17,900. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
And as always on a Friday morning, we welcome Francis Lun, who's the CEO of GEO Securities. Morning, Francis.
Hi, good morning.
And also joining us is Simon Kavanagh, who is partner at BDA Partners. Welcome, Simon.
Morning, Peter.
Now, the Hong Kong Monetary Authority on Thursday left its base rate unchanged at 5.75% for the 7th consecutive meeting. That was after the Fed left monetary policy on hold, and the HKMA has followed the Fed's rate decisions in lockstep since 1983 under its linked exchange rate system, and that helps preserve the local currency's peg to the US dollar. In a statement, the HKMA said that with recent economic data showing mixed signs and inflation remaining high, it's uncertain when the Fed will start cutting interest rates. And leading local banks, including HSBC, Bank of China and Standard Chartered, announced they were keeping their base rates unchanged. Francis, this may well be the right rate for the US, but it's not very good news for Hong Kong, is it?
Definitely not, because compared to previous years, you have to pay a lot more for our mortgages. I think if they cut the interest rates even slightly, I think they will do wonders for the property market in Hong Kong. I think because high mortgage payment, the property market is really falling after a small spike after we cancelling all those restrictive measures.
All the spicy measures.
Yeah, that's right.
So, Simon, what can we do here in Hong Kong? We're locked into the Fed's monetary policy. It seems clear from their statement on Wednesday that at most we'll get one interest rate cut this year, and there's still quite a few people on the Monetary Policy Committee who thinks there won't be any cut at all.
Well, for Hong Kong, I mean, this is the price of the peg. We just have to follow the US, and nothing's going to change there. And yep, sometimes it works in our favor, and sometimes we're economically sort of on the same track as the US, and sometimes we're not. But I don't think anything's going to change there. For the US, I mean, I know you had a long chat about it yesterday, but it's really a case. I mean, interest rates will come down. Inflation is moving in the right direction, but it's just taking longer than I think people anticipated. And so the question, and it'll be the question that the Fed doesn't have the answer to either, is at what point do they start cutting rates, and how close to the 2% target do they need to get in order to start doing that? Because I think they'll start cutting before, obviously, they get to their 2%, but they need to know that it's on track.
And also, how many data points do they want to see before they're confident that inflation's on track for that 2% target? Because clearly they don't feel they've seen enough yet, do they?
No, exactly. I mean, everyone always comes back to their term, data dependent, but also the data is pointing to slightly different things depending on which metric you look at, and some are higher than others. They're all trending in the right direction generally. Some measures are perhaps slowing down in terms of their rate of fall, which may be a cause of concern. But obviously, yeah, it's really a wait and see at this point in time. So the speculation over whether we'll have one cut or two cuts this year, maybe we'll have none, reading into the dot plot and the sort of consensus and across the sort of the 19 panelists on that dot plot, who's in favor of what. I mean, as we've seen with the announcement this week, I mean, things have changed really quite considerably since the last one, and I expect it'll change again when we have the next one.
You know, the thing I'd be interested in that dot plot is which one is Jerome Powell's, because obviously they don't identify themselves, do they, with those dots? It'd be interesting to know what his thoughts are. Does he see one cut or two cuts or none at all? I suppose we won't know, or I'll try and glean something from his comments in the media.
And also, I'd be very curious to see how things have changed over time as they get the data and they realize that actually perhaps they were a little more optimistic, or they felt that their monetary policy was having a stronger effect previously than perhaps it's turned out to be. And then there are obviously macro issues that come into play sort of globally. So yes, but it would be lovely to actually see how things change over time.
The Fed says all the time, it repeats this statement that it's data dependent. Do you think the decision-making process is clear? And do you think then when new data comes in, is it clear that the Fed is reacting in a way that's consistent with that process, or is it all a bit vague and fuzzy?
I think they do react. I mean, we can see the shift in expectations from meeting to meeting. So they get new data, and I think the data is perhaps not what they expected it to be, and therefore their forecasts and their outlook alters, and it can be read into tiny nuances in some of the wording, and it can be more visible in, say, sort of the charts in terms of forecast interest rate cuts. But I do think they are following the data. The data is perhaps not coming out perhaps where they expected it to.
Because the reason why I ask is because this is quite a big change in 3 months in the dot plots, isn't it? From 3 cuts 3 months ago to 1 cut now, and I'm wondering what's in the data that's promised that change, because it's been pretty clear from the data all along, isn't it, that inflation's sticky, it's above 3%, and it's sort of hovering above that sort of level. So I'm wondering why the sudden change now. Was it maybe that they just got it wrong 3 months ago?
I think it's just a slower rate of decline than perhaps they anticipated. It's really as simple as that in terms of actually drilling down into the specific components within the various data sets that they track. I don't know if there's one thing that's swung it more than others, but I think it's just essentially the interest rates are having a slower impact. Wage growth in the US is still particularly high. Sort of the hourly wage growth is up above 4%, I believe. So it hasn't had that impact on employment that I think historically the economists would have said it should have had by now.
Francis, do you think we will get that 1 interest rate cut this year?
Yeah, I think so. Jerome Powell almost promised it. If we don't get it in September, then the market will tank.
Well, if it doesn't come in September, they've really got to wait, haven't they, till December? Otherwise, they're going to be accused of interfering in the election. So their window is narrowing.
Yeah, that's right. I think the key is still the core inflation rate is still about 3%. Yeah, it's not falling below 3% anytime soon. I think that's the crux of the problem.
Yeah, and we saw that, didn't we, from the CPI data on Wednesday that came out just before the Fed. It was a bit lower than expected, but it's still above that 3%, 3% level.
Yep.
So from Hong Kong's perspective, let's suppose the Fed does cut by 25 basis points by the end of the year. Is it going to make much difference to Hong Kong?
Well, only psychologically. I think the major banks will probably cut the interest rate by maybe 0.25%, but the mortgage rate is dependent on the interbank rate. I think it might fall maybe by 1/8%. So any effect will be psychological.
We've got to do something here, haven't we, to try and find new ways of developing our economy, because the monetary policy is what it is. We can't change that, as you said. So do we need to think of some new things that Hong Kong needs to be doing? Because we're stuck in a bit of a rut economically, aren't we?
Yeah, definitely. I think the problem still with the financial markets not really doing that well. But one thing have changed is really the IPO market. I think the last 4 or 5, everybody makes some money.
That's almost back to the good old days.
Yeah, almost good old days. So I think that's a good sign. I think we see some signs of recovery.
But where we've got to sort of think is on consumer spending, because spending patterns have changed, haven't they?
That's right. I think if you go out at night after 8 o'clock, all the restaurants are empty. Nobody going out. I don't know why.
Yeah, and people are leaving in droves at the weekend to go to Shenzhen and queue up outside Costco.
Yeah, that's right.
So, I mean, what do you think? Do you think we need to do something here? We've got there are some structural changes going on, aren't there, at the moment in the economy? Some of this data that we're seeing, particularly on consumer spending, retail sales, it's not just a cyclical factor. There's some real changes going on. Have we got to adapt somehow?
Yes, we do. We can't go on sort of with the way it was before, and I think in terms of Hong Kong as a service industry, I mean, it's not going to come back and be a manufacturing hub, but as a service industry, it needs to reinvent itself to some extent. Tourism needs to be encouraged, and so we need to obviously have in place something that will attract tourists, both from sort of mainland and also internationally. And we've got to play to those strengths which we have, both sort of the city itself and then sort of the surrounding countryside and the islands and the new territories and things. We've got a unique environment here, and that needs to be played to. And then from the economy itself, I mean, as Francis says, yes, it would be great if, from the finance sector's point of view, the stock market were to rebound. And I think it will. But the question is just when. We need a little bit of good news, and obviously interest rates coming down would help that. But the property sector, I mean, there is actually quite a lot, I think, that the government could do there in terms of encouraging construction of affordable housing and taking some rather difficult decisions to make more land available, which could be built on. And there's now an awful lot of Hong Kong which is really very old, built in the 60s and 70s, and that should be redeveloped, and legislation to encourage that, I think, would be a good idea.
And there has been this big debate recently, hasn't there, about whether we're too closely linked economically to the mainland and therefore just totally dependent upon it. But at the same time, it does seem the more we integrate, the more we lose business to the mainland. I mean, maybe shipping's a good example, isn't it? I mean, but ships don't need to come to Hong Kong now. They can go directly to Shanghai or Ningbo. So is that part of the issue?
I think so. I think that the problem with shipping is that when your factories are in China, it doesn't make sense to ship your goods to Hong Kong and then load them on the ships here. That's why. Well, I think Hong Kong's role as a transshipment port will one day will be over. I think we really have to face the reality. We will lose the container port sooner or later. I think the sooner better. I think. And it's already happening now. You go to the container port, you see half the berths are empty. So that leaves us with really only finance and real estate and tourism. I think that's what we have to concentrate on. And Hong Kong has, the high-tech industry is still too small to make an impact on the economy.
That's what we're missing out on, isn't it? We definitely do not have a sort of a high-tech... No. We're not a high-tech hub here, are we?
No. I think, the government has put a lot of money in it. We have
why is that not working?
Well, you don't have the number of people like Taiwan. Taiwan has a lot of immigrants who return and set up factories, but Hong Kong people, most of, because real estate is too profitable, most people go into service industry, not into research in the semiconductor or software. I think you can explain that. I think real estate really harm the Hong Kong economy in the long term.
On your point about shipping, I suppose there's one thing I would add to that, which is that although we may be losing container shipping going directly to China, we do have all the services around shipping which are very much still in Hong Kong, like insurance and logistics. So that's good for us, isn't it?
Yeah, I think so. But the Hong Kong airport is still doing growing business in air freight. It's still one of the major air freight hubs in the world. I think we have to hang on to that. Otherwise, we will be off the global map.
All right, well, let's talk about electric vehicles, because that's the other big news of the week, isn't it? Brussels has announced tariffs on Chinese electric vehicle imports of up to 38% as the EU tries to stem the rising tide of cheaper imports. Tariffs are going to vary according to the brand. So the world's largest EV producer, BYD, has only been hit, I say only, with a 17.4% levy. But Geely Auto is going to be subjected to 20% tariffs, and those car makers that didn't cooperate with the EU investigation into Chinese subsidies are going to be hit by 38% tariffs. Now, that's in addition to an existing 10% levy. Simon, what's this going to do, first of all, for the Chinese automakers?
So, I mean, they still have fairly large profit margins, and they've obviously got a lot of capacity that they need to absorb somewhere. I think they will continue to try and export to Europe. I think the great thing in their favor is the cars are cost effective, but they're also very nicely designed, and so they're sort of, I wouldn't necessarily describe them as cheap, but they're good value and they're reliable. And I think the consumer actually wants more electric vehicles. You see how particularly here in Hong Kong, you see how quickly they've been absorbed, the number of BYD cars you see out, and MG, and the sort of the Maxus from SAIC, the 7-seater seems to be everywhere now. So they've got good cars. I think they will continue to penetrate in Europe. The question, I suppose, is how much of these tariffs are genuinely because China subsidizes or provides a lot of preferential financial treatment to these car companies, and I think that is a valid criticism. But it's also that the European car manufacturers are slow in terms of coming up with their own versions of electric vehicles. And they need, essentially, the European Commission's giving them a bit of time to catch up. Now, the German car manufacturers are a little more, they know it needs to be balanced in terms of their relationship with China and the amount that they sell here in China. And they also, I mean, you have instances like Tesla, fine, it's not European, but they're manufacturing in China and exporting to Europe, so that they wouldn't necessarily have been the target of the European Commission. So we'll see. I mean, BYD will continue to be very successful. And it's the fact that SAIC is subject to much higher tariffs because it did not, it didn't provide the information asked, it didn't participate, and BYD did participate, and as a result has significantly lower tariffs. I think that sends quite a strong message for any future investigations that the European Commission undertakes.
You say the EU gives these car companies a bit of time to catch up. It would have been nice, wouldn't it, if there was some sort of sunset clause on this to say, okay, you've got maybe 2 years, then these tariffs are going to go, because otherwise, where is the incentive to make European manufacturers maybe more efficient and cheaper, more cost effective? Because when the US did this on Japan, it didn't do anything for the US manufacturers, did it? It didn't make them more competitive, didn't help them overtake Japanese car makers. Toyota still became the biggest manufacturer in the world. Isn't the same thing going to happen here?
Well, I think so. I think you look at standards, isn't it? They have 20% of the lead motor in China. They don't plan to make EV of their own. They just plan to import EVs from China to Europe under their own brand name. I think they come to the conclusion that their costs will not be as slow as China's. So if you cannot beat them, just join them, be a partner in it. I think that is the attitude of European manufacturers now.
So what do the Chinese manufacturers do in terms of Europe? Does it now make sense for them to be maybe more aggressive in opening factories and plants in Europe itself rather than exporting out of China?
Well, I think in exactly the same way that Toyota did in the US and all the Japanese car companies, they set up their own plants in the sort of southern US away from the sort of North America, sort of around Detroit hub of the US automakers. And we're starting to see that now. BYD announced its big plant in Hungary that it's building, and that'll be partly why its sort of share price has not suffered nearly as much. I mean, it's getting lower tariffs, and it is sort of ahead of the other Chinese EV car companies in terms of it's going to have a manufacturing footprint within Europe very soon. So it's following that tried and tested route from the Japanese in the US, and I think that will continue. I'd be surprised if we didn't see Geely, for example, opening something in Eastern Europe in the near future.
They call these tariffs, but this is really, when push comes to shove, it's a tax on European consumers, isn't it? Because
yes.
the Chinese companies, well, even with all these tariffs, they're still going to be cheaper than European vehicles. It just means, though, that consumers are going to have to pay more for their cars. Is that the right way of looking at it?
Yeah, definitely. I think look at the BYD seal. I think it retails in China for 20,000 euros, but in Europe it's retailing for 40,000 euros now. The extra 20,000 euro profit goes to BYD directly with 17% profit margin. I think maybe BYD will just set up the price to maybe 50,000.
So what does President Xi do? What does China do? Does it retaliate?
Well, it already has. I mean, and this is where, I mean, it's quite amusing. So Germany was fairly vocal in saying that they didn't want tariffs. The argument for tariffs was led by Spain and France. And sure enough, I mean, literally the day after the announcement of the tariffs, China comes out and says that it's referring European pork imports to the world, to the WTO. And pork imports into China, where do they come from? From Europe. Funnily enough, they come from Spain. So, so I mean, a very sort of clever but sort of expected move from China. They're punishing Spain, and
they're going to punish France as well, presumably.
They'll come up with something for France, I'm sure, and they'll let Germany off the hook. So it's not going to be sort of tit for tat just in the auto industry. It'll be managed. But the question is, how do you then start sort of walking your way back from this? Because as you say, there's no time frame, and once these tariffs are put in place, does it become politically difficult to unwind them? And kind of what's really the goal at the end of the day? Is it to let your local manufacturers catch up? Because the other aspect that'll come in, of course, is climate change, and are we actually meant to be encouraging people moving towards electric vehicles? The government will say that on one hand, and they want to get to net zero, and then consumers will go, well, hang on, you're just making my life harder and making things more expensive for me. And some of the smaller, I think Malta in particular, came out and said this in criticism of the European Commission's decision.
There's going to be about a month before these tariffs are finalised, and the EU is saying it wants to try and see if there's another way and sit down with China. Do you think China will be interested in that? Is there enough pressure on China, or is it in its own interests maybe to try and find a way of avoiding these tariffs?
Well, the EU's version of import duty is already much less harsh than the Americans. I don't think the EU will buzz. I think even with 17 or 20% tariff, I think Chinese manufacturers will survive. Will continue to thrive in the European markets. US.
Do you think China will try and find a way of negotiating with the EU? Maybe agreeing to open plants in Europe in return for lower tariffs or something like that? Is there enough incentive on it to try and do something to avoid this? Because it doesn't really care about the US, does it? It's not bothered about, because its exports to the US in EVs is so small, but it must surely care more about the EU. This is a big market.
Yeah, I think they should do something, but already BYD is committed to build a plant in Hungary already, and several others are building plants in Spain and Italy and other countries like that.
Let me just finally ask you about the local markets. Well, here in Hong Kong, obviously a couple of things going on today. We've got the Bank of Japan monetary policy meeting, and then overnight we had US shares hitting another record high, the S&P 500 and the Nasdaq. I think that's the fourth day in a row now they've been at record highs. What's the outlook here for Hong Kong shares?
Well, I think yesterday it was the EVs and then the handset suppliers that are supporting the market. I think the AI boom in the US is really giving the tech stocks in Hong Kong a boost too. I think the Hong Kong market will get back to the 18,000 level and then beyond. I think I think Hong Kong market is on a slow way to recovery.
Simon, final thoughts from you?
Yeah, I agree with Francis that Hong Kong will slowly work its way back, and we've still got a lot of inflows through the Stock Connect southbound, which are helping the market. In the US, I don't know. I mean, we've sort of tied ourselves into a kind of historical knot to some extent, focusing on the S&P 500, which is now, as everyone knows, dominated in terms of its movements just by a handful of companies. So is it really a good barometer for the health of the US economy, which is how it's interpreted, for it to keep on going to sort of constant records when you've got a sort of high interest rate environment and a geopolitical situation and an election coming up? I'd sort of query reading into it, going, hey, sort of the US economy and the US stock market's never been healthier. I don't think that's the case, and so I wouldn't focus or be overly optimistic just because we're hitting record highs.
It's no longer the Magnificent Seven, it's the terrific three, isn't it?
Yeah,
Microsoft,
that's right.
Apple and Nvidia.
Yeah, the 3 trillion Australians.
I'll give them their own index.
Yeah. Okay, well, look, have a good weekend. Thank you very much. You heard there Francis Lun, who is the CEO of GEO Securities, and Simon Kavanagh, who's partner at BDA Partners. I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Good morning, Peter.
I'm interested in your thoughts on the Fed. Obviously, they left interest rates unchanged. No surprise there. What maybe was a bit of a surprise was the dot plots. A big change in opinion there from just 3 months ago, where the FOMC was predicting 3 rate cuts before the end of the year. They've now cut that to just 1. Why this sudden change?
Well, I think the clear message was that they've had some progress. So inflation is heading towards it, but just insufficient progress and going too slowly for them to lift any restrictive policy. They've got this mix around the payrolls and the labour market being strong, whereas other parts of the economy have definitely slowed up. So I think they clarified that no one's looking to hike rates, so we can take that off the table. But the idea that they can move more quickly into cutting policy and lift restriction is just not there. They're not confident enough. Insufficient confidence, I think, with some of the language. Modest improvement in the inflation outlook. Slightly hawkish, but to the extent that was just a consideration of changing a 3-cut strategy to a 1-cut strategy in 24.
Is it clear from what the Fed was saying and what Jerome Powell was saying as to what they want to see to make them go and cut rates? Is it more data, even if the data just reaffirmed what's happening at the moment, or do they need to see actually inflation moving further downwards and start to see a bit more of a disinflationary process?
So sub 3% is what you want to see in your core inflation numbers, I would suspect, for the Fed to be confident. Now, we're not that far. Well, we see CPI, we got at 3.3 versus 3.4, but marginal movement versus the expectation. It was positively taken. And the PPI, which is the one that came off the hardest because of the cost push inflation being taken out on post-COVID, it's still above 2%. So even though it's close, 2.2, it's not below 2%. I think these are the numbers that the Fed want to see. PPI numbers coming in sub 2 or around 2 consistently, and definitely sub 3 on CPI before they really feel confident that they've got inflation beat. The biggest thing for them is they just don't want to get it wrong, because entrenching inflation expectations, if they go the other way, will be making a really tough job to resolve.
So then we've got to see a change really from what the data's saying at the moment, because the data's been fairly consistent, isn't it? If you look at it, it's always 3 point something. It might be 3.3, 3.4, 3.5, but we need to see a renewed push downwards in inflation in that case for the Fed to start cutting.
Yeah, and in that regard, you need the economy to slow, probably be a little harder than what it is. At the moment, the economy is still going well enough for the Fed to be confident to just hold the restrictive policy where it is. And so until we see some more aggressive softening in the labour market, so some loosening in the labour market, maybe a more substantial cut in economic activity, which we're just not seeing, in US data, then right now there's just no reason for them to move more quickly. There's not enough evidence to suggest they need to make a move, as opposed to what we saw in Europe, Canada, and some other countries, is that their economic figures are much flatter, much softer. So they've got. Yeah.
So based on what we've got at the moment, they're right, aren't they, just to leave rates on hold right now? The level of interest rates is probably about right for the economy as it is right now.
That would seem to be the case. And erring on the side of doing nothing's often, the best strategy. Let things play out. It's probably a more predictable strategy for the Fed right now. There's not enough volatility in the data sets to suggest that they've got it completely wrong, and the soft landing is still a scenario that can play out. No need to jump in front where the data is showing them that things are going still pretty well from an economic perspective. That's notwithstanding some of the pain that's happening in terms of cost of living at the coalface, at the consumer level. And we discussed this previously, that whilst it appears that inflation's softened, price rises in some of the consumer staples, things that really hurt the hip pocket and can't be adjusted for consumers, is still hurting. And so what actually is felt versus what actually is happening in the economy are often two different things.
We are seeing, aren't we, more signs that the labour market is softening. We had those weekly jobless claims last night, jumped the most in 10 months, which is added to other bits of data we've seen over the last couple of weeks, which suggests the labour market is softening. Could that eventually feed through to inflation, in that maybe it holds back consumer spending if people are worried about their jobs, which obviously is deflationary? Could that be the thing that starts to bring inflation on the next leg down?
Well, one of the key economic variables, the key economic variable in terms of expectations on anything for the consumer, is employment. If you are worried about losing your job, then your behaviour changes quite dramatically. And this is one of the things that hasn't happened in this cycle, where even though we've seen significant interest rate hikes and slowing of activity, the level of job losses hasn't really hit the zeitgeist, if you will, of people's expectations. And as such, they're not feeling as their confidence is still reasonable. You can see that through the numbers. So what changes dramatically is if people feel they're going to lose their job. That changes spending patterns, that changes behaviours quite dramatically. And I think the Fed probably expected to see more of that, and therefore a more aggressive decline in inflation, and it's just not flowing through. And that sort of paradigm is one of the complexities of the new economy. We haven't seen the labour market react in the same way as it would historically to, tighter monetary policy.
Now, the money markets are still pricing in 2 rate cuts this year, which suggests the markets must think either inflation is going to come down or the economy is going to get worse, or they think the Fed is just going to cut anyway before the end of the year, presumably.
Yeah, they've had swings and roundabouts, Peter, in regards to their pricing of expectations. So they've had, they've started off at the beginning of the year with June cuts. They've had to adjust that. They went, they've brought it back to about a 50-50 chance in September. Now that's back to a 70-plus chance. And as you say, so they're still not quite in line with where the Fed is, at least in terms of its dot plot. So that's the beauty of markets. They'll play around, and at some point they'll be right. And markets aren't always too far off the mark. So if you're an investor or you're thinking, just watch the Fed versus watch the market, I think you just got to take a bit of view on both. And they're not too far apart now in terms of where their expectations are.
Now, we should mention that the Bank of Japan's meeting today, they're sort of got the opposite problem from the Fed. The Fed wants to cut, but the data isn't really helping it. The Bank of Japan wants to raise rates, but the data isn't helping them either.
Yeah, they've got a tough situation. GDP at sort of almost minus 2% on a quarterly basis, but they want to hike rates in order to get some more inflation into their economy. They want to see it sustainably around that 2% level, and they're not quite there. Growth is mixed over there. The recent survey of large manufacturing firms was better than expected, so there is some elements of positivity around the economy, but overall GDP is benign. What they may do, and this is what the market, 2/3 of the economists are expecting, is that they will reduce their bond purchases. So some sort of quantitative tightening versus leaving interest rates steady at very, very low levels as they are, around 0.1. So it's a mixed bag for the Bank of Japan. I suspect that what we'll see is the highlight and the headlines will be around the bond purchasing.
And what's the situation like in Australia on the domestic fronts, both economically and in terms of inflation as well?
So we had labour force figures this week, so unemployment, and we had the unemployment rate dropping, so 4.1 to 4%, 40,000 full-time jobs created, which was a bit of a surprise. They were expecting 30,000. The participation rates at 6 months highs, which suggests maybe more people looking for work. There's no doubt in the Australian economy that people are struggling on the cost of living side. But similar to the US, it's not feeding through to labour market stats at this point in time. The Reserve Bank are still much of the view that we're still in a potential hike, but this is probably less likely than a cut. But we're certainly not looking to cut rates this year. I think ANZ Bank, which is one of the big 4 banks in Australia, made the move this week to inform its customers that they don't expect rates to be cut before 2025. And that's a shift from the other major banks who are still predicting that we may see something lower this year.
And I presume that the housing market is a big factor in Australia because unlike in the US, households don't really have fixed rate mortgages, do they? So they're very exposed in terms of their mortgages to what's happening to interest rates.
There's been a lot of data on this and a lot of speculation around the impact of people coming off fixed rate, low fixed rate mortgages are back onto variable. You're right. There's a certain percentage, probably a larger percentage on variable rates than on fixed rates. That data, it was sort of calling it a bit of a cliff impact on the housing market. Just hasn't happened. One of the big drivers of that is that we have a structural undersupply of housing in this country, particularly with the amount of migration coming through. It was only announced this week that we had a record high of more than 500,000 people coming into Australia in the last year. And when we're building probably less than 100,000 or 200,000 houses a year, we have this chronic undersupply. So the housing market, regardless of mortgage stress, regardless of that, just is not being impacted. And as a result, prices in property continue to stay elevated and, continuing to go up. Not so substantially, certainly has slowed, but we haven't seen prices come off, and that's really a structural issue in Australia.
And how much is the Australian economy exposed to China and the slowdown that we've been seeing there?
Definitely, largest trading partner, China. We actually have the Premier Li Qiang out this weekend visiting. I think he's visiting pandas in Adelaide, and we're having high-level business talks. This is part of I guess, an initiative from China to re-embrace some relationship with both New Zealand and Australia. That's going to be good for trade. But the Chinese economy's softness certainly doesn't help, although they still have been purchasing, iron ore and coal, our two biggest exports. One sector which may be impacted in terms of export is the education sector, with both, and this is where both sides of politics here in Australia are trying to reduce the numbers of international students and the amount of migration into Australia. That might have some impact on the relationship with China, because we see quite a lot of Chinese students coming out to study in Australia. So there's a few things on the horizon. Overall, Australia is trying to rebuild its relationship with China after the last few years, and that seems to be going pretty well. And the visit of Li Qiang is really quite significant in that regard.
Because you went through a bit of a rocky patch, really, didn't there, when there was tariffs on wine and wheat and barley and beef, all sorts of things. But they've pretty well been removed now, I think, haven't they?
Yeah, almost all of them, not all. But certainly the dialogue's improved. Both sides talking more positively and optimistically about the relationship. So this visit this weekend will be quite significant. It'll be well reported, both in China and in Australia. And I think it's really aimed at trying to consolidate on the trade side and on the business side some of those export-import relationships that we have.
Well, we'll track this visit and we'll talk about it more next week. Thanks very much, Toby. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Nitin Dialdis, Chief Investment Officer at Mandarin Capital. And providing a view from mainland China will be Yanan Wu, the Chairman and CEO of Surfing Group. Have a great weekend.
Money Talk.